Today is going to be the day that completely revolutionizes the way you think about trading and the way you trade. The days of getting absolutely killed are over starting now. The main problem that nobody teaches you and nobody will teach you unless you're paying a lot or if you go through some bumps and bruises is how to correctly do your position size. The question is, how much do I actually put into an investment? So I don't know how many of you have heard of Rich Dad, Poor Dad by Robert Kiyosaki, but this guy is an absolute genius. And kind of the premise of this book is that there are two ways to think about money. One way to think about money is to think, oh, I got $10,000. How can I spend this? What am I going to buy with it? How can I blow it? And then the other way of thinking about it is, I have $10,000. How can I take this $10,000 and grow it into $11,000 or $20,000? What can I do to invest this and make it into something more than what it is now? And that fundamental change in the mindset of people is what separates the rich from the poor. So that's the premise of his book. Well, I would argue that there's a rich way to trade and there's a poor way to trade. And the number one problem is position sizing. So if you go back to Investopedia, they even talk about it. So this isn't something you have to search very far to figure out. And it simply means that it's just how much you're investing in a specific trade. If you scroll down, this is typically expressed as a percentage of the investor's capital. As a rule of thumb, most retail investors risk no more than 2% of their investment capital on any one trade. Fund managers usually risk less than this amount. If you've been on my channel for very long, you have heard me say over and over and over again, I never put more than 1% of my portfolio into a single trade. If you're trading more than a couple percent of your entire portfolio, I have a question for you. How soon do you want to get liquidated? Because every single trade has risk. We need to stop thinking about trading as I'm buying a lottery ticket. I'm going to buy something. I'm going to put all my money on black and I'm going to spin the wheel. Either I walk away completely broke or I walk away with life-changing amounts of money. All of the noise about people 10xing their money or 100xing their money and all of that, that is people getting lucky. There is very little strategic about that. Even gamblers are better investors than a lot of people that are trading. When people go into a casino, do they take their $1,000 that they're planning on gambling and put the entire thing all in one thing? No. They realize that they have 5 hours to blow. They're going to lose $1,000. And so they start timing and diversifying they're diversifying how they're losing their money, if that makes sense. So they are slowly putting in money, and when they start getting low, they start going from quarter slots to penny slots or something different, and they milk it all the way out until they've lost all their money. Traders, we don't even manage our money that well. If a new trader comes in and they're like, well, I just really want to buy Litecoin today. And so they take their entire amount that they have, their entire $1,000, and boom, it's all in Litecoin. Well, what are you going to do if Litecoin has a tough month. You're going to stress about it. You're gonna sell on the way down. You're gonna try to liquidate that position. You're gonna be emotional. You're gonna have a bad day. You've given yourself no chance to spread out that risk and recover from it. What we want to do as an investor and trader is we want to make decisions that give us a little more than where we started and limit the amount of risk that we are putting in. So your majority of your capital is going to be in a certain base asset. In my case, I use Bitcoin as my base. 100% of anything that I want to spend and live on, my base currency is in Bitcoin. If your base currency is in dollars, then you'll need to then you're going to want to trade using dollars. But I'm interested in holding Bitcoin for the long term, so that's my base currency. Well, whenever I enter any kind of a trade, I am only buying 1% of my total portfolio in the most liquid and largest coins. So Ethereum, XRP, Litecoin, any of these major coins, those are the ones that I'm buying and selling 1% of my portfolio. I'm interested in making 20% or 40%. And if I have an amazing killer year, maybe 100%. But I'm not trying to 1000x my portfolio, because rather than 1000xing your portfolio, what usually happens is you end up negative 100%ing your portfolio. You start getting emotional. You start making dumb decisions. You want to make up for the loss that you had, so you try to invest even more, or you find even riskier ways to invest because you're trying to make up for money that you lost. All of this is complete lack of risk management, and risk management starts with small trades. So there are a couple of reasons why we keep our investment sizes, our position size, small. The number one reason is that it allows us to not get emotionally overwhelmed. All trading is emotional. And when we make big positions, it will really make making sensible trades difficult. If we're looking at things objectively and we have a small amount of money that we're putting in, we can now look at that investment with way more clarity and way more analytical insight, rather than just running with our emotions, because we all know that markets aren't here to help make us money. They're here to trick us into selling and buying at the wrong times and losing our money, and emotions have 100% to do with that. The second most important reason why we keep our position size small is so that we can recover. Trading is a game of statistics. There are odds that you'll win and there are odds that you'll lose. And there are odds of your gain percent is a statistic, and your loss percent is a statistic. You can gain more than 100% in crypto. You cannot lose more than 100% as long as you are simply selling. If you buy something and it goes to zero, you've lost 100%. If you buy something and it triples, you've tripled your original investment. So we're looking at risk reward. Well, if even in the very best trade, we have a trade that we are 90% confident in, there is still a 10% chance of that trade going upside down. So if you have a 90% chance of winning and a 10% chance of losing, the poor trader mindset will be, I'm going to put everything I've got into this because 90% is such good odds that nothing could go wrong. Well, you're completely forgetting the fact that there is a 10% chance that things can go wrong. It's built into every single trade. Every single trade can go wrong. You don't have to look very far, but an indicator, a setup, everything that's looking perfect can completely go upside down without any warning. And so, what kind of position do you want to put yourself in? You want to put yourself into a position where you have a sensible amount of money in your portfolio, and then if things go wrong, all of a sudden, rather than that being a complete destruction of your portfolio, suddenly you have a baseline to measure your success against. My trade now is, let's say, 40% down. Wow, the market just gave me a 40% discount on a trade that I'm interested in. Guess what? You have lots of capital available to take advantage of the next good setup. If the first good setup didn't work, chances are better that the second good setup will work because prices are lower. There's smarter money buying. Buying at a good place where the risks are in alignment is already a good idea. But when that goes wrong and you have another perfect setup down below, that's the one that might double your money or do better. If you're all tapped out at a higher level, you're not going to be able to take advantage of gifts that the market that delivers you when the market goes against you. I can't tell you how many trades I've had where I've had the perfect setup. I enter, and suddenly everything falls apart and it goes way down. And in those cases, I still have capital available to rebuy when things cool off, and another perfect opportunity presents itself. Well, when I take that position, and then the market does come back with a vengeance, I can make more than I ever would have lost on my other position. I just wish I could get into the minds of all new traders and help them see that we're not trying to make millions of dollars. Even the trade that would make you $1 million, like the emotions behind that trade, if you made a single trade that would eventually make you $1 million, you would be so emotional, there is no way you would take advantage of that trade. What would happen is on the way up, you would start feeling like, oh wow, I'm at 100,000. Like this is unbelievable. And then it drops back and you get it back to like 75 or 50,000. You're like, oh, I should have sold at 100. Oh man. And you would sell at 50 or 75. Or it gets back to 100,000. You're like, oh, I'm not going to miss it this time. And so then you sell at 100,000. And then it goes on to 1 million. When you're trading and you have 100% of your capital involved in one single trade, you're going to make mistakes and you're not going to be able to hold on through the ups and downs that a trade gets there. So what we want to do is we want to diversify our trades. We want to take many good trades. And in future videos, we'll talk about where those trades are. But for now, we need to practice making small trades. We buy a 1% amount of our portfolio and we watch it and we take advantage of highs and lows, and we can pivot, we can adjust, and we're not going to wake up the next morning and be completely bankrupt. Like everything is going to be measured and comfortable, and we can slowly work through the ups and downs of these markets.